Welcome to my video on the 2025 Canadian election impact on real estate and mortgages. I'm Tim Hill with Dominion Lending, Primex Mortgages. Welcome back to my channel. The 2025 Canadian federal election is behind us, and with the Liberal Party securing a fourth term under Mark Carney, there's a lot to unpack for homeowners, buyers, and investors. As a mortgage broker, I'm here to break down what this election outcome means for Canada's real estate market and your mortgage. In this video, we'll explore the Liberals' housing promises, how they could affect home prices and affordability, what's happening with mortgage rates, especially with U.S. trade tariffs looming, and tips to navigate this market. Let's dive in. The Liberals, led by Mark Carney, won the 2025 election, promising big moves on housing affordability and economic stimulus. Their platform includes over $25 billion for housing, tax cuts, and GST relief on new homes under $1 million. These policies aim to boost home construction and make buying easier, especially for first-time buyers. But with U.S. tariffs threatening Canada's economy, there's uncertainty about how these plans will play out. As a mortgage broker, I've seen how government policies shape the market. So let's look at what this means for real estate and your mortgage. The Liberals are doubling down on housing with a goal to build nearly 500,000 homes annually over the next decade through Build Canada Homes, a new federal agency. They're also offering GST exemptions on new homes under $1 million and expanding 30-year mortgage amortizations for first-time buyers and new builds. Plus, the insured mortgage price cap is now $1.5 million, meaning you can put down less than 20% on pricier homes. What does this mean for real estate? These changes could spark demand, especially in high-cost cities like Toronto and Vancouver, where the new cap helps buyers. In 2024, the national average home price was around $678,000, but places like the GTA hit $115 million. More buyers qualifying could push prices up 5 to 6% by Q4 2025, as Royal LePage predicts. However, new supply from construction might ease price pressure in the long run. Now let's talk mortgages. The Bank of Canada cut its policy rate to 3.75% in 2024, and economists expect it to drop to 2.5% or even 1.5% by late 2025, especially if U.S. tariffs trigger a recession. Variable rate mortgages, tied to the policy rate, could fall to around 4.5%, making them pretty attractive. Fixed rates, linked to bond yields, are trickier. Yields are volatile due to Trump's proposed 25% tariff on Canadian goods, which could weaken our economy and drive inflation. Some experts warn fixed rates might not drop much if U.S. Treasury yields rise. For you, this means variable rates could save money short-term, but fixed rates offer stability if inflation spikes. About 60% of mortgages renew in the next 2 years, and lower rates could ease the renewal wall for many. The elephant in the room is U.S. tariffs. Canada exports 75% of its goods to the U.S., and a 25% tariff could slash GDP growth by 3%, potentially tipping us into recession. This could cool the housing market, with KREA forecasting a slight 0.3% drop in average home prices in 2025. Sales are already down 20% from recent highs due to tariff fears. On the flip side, lower rates to counter economic slowdown could boost buyer power. But if tariffs raise construction costs, like rebar or lumber, new home prices might climb, hurting affordability. But Calgary's market, tied to oil, could see gains if Trump's energy policies strengthen Alberta's sector. With all this change, you might be thinking of refinancing or breaking your mortgage to lock in a lower rate. But watch out for discharge penalties, especially for fixed-rate mortgages. The penalty is the higher of 3 months' interest, or the interest rate differential, also known as IRD. IRD compares your contract rate to the current rate for the remaining term. If rates have dropped, like they have since 2022, IRD can be costly. For example, on a $400,000 mortgage at 4% with 3 years left, if the current 3-year rate is 2.5%, the IRD could be 1.5% times $400,000 times 3 years, or $18,000. Lenders calculate IRD differently. Some use posted rates, inflating costs. Check your contract and ask your broker to estimate penalties before making moves. How do you navigate this market? Here are 5 tips. 1. Lock in rates early. Contact a broker to secure a rate up to 120 days before buying or renewing. Rates could rise if tariffs spike inflation. 2. Explore variable rates. If you can handle fluctuations, variable mortgages might offer savings as rates drop. 3. Leverage new rules. First-time buyers should use the $1.5 million cap and 30-year amortizations to lower monthly payments. 4. Check penalties. Before refinancing, calculate discharge penalties, especially IRD, to avoid surprises. 5. Stay local. Markets like Alberta might outperform due to oil, while BC and Ontario could see softer prices. Work with a local realtor for insights. Looking ahead, 2025 could be a mixed bag. Lower rates and liberal policies should drive sales, especially for first-time buyers. But tariffs could dampen confidence. By 2026, if tariffs ease, TD Economics predicts a rebound in sales and prices as pent-up demand releases. For now, affordability is improving. Mortgage payments as a share of income dropped 0.8% in Q4 2024. But with prices still high, plan carefully. The 2025 Liberal win brings housing opportunities, but also challenges with tariffs looming. Expect lower mortgage rates and more buyer-friendly rules, but stay cautious about penalties and market shifts. As your mortgage broker, I'm here to help you make sense of it all. Want personalized advice? Drop me an email or your questions below. Thanks for watching. Hit like, subscribe, and share to stay updated on Canada's housing market.